Hello, fellow investors. This is InvesTips, and welcome back to another video. Today, we will be going over 9 beginner invest tips and showing you how you can implement them today to expand your portfolio and build your wealth. I have used these strategies myself and have been able to secure 10% gains across multiple days, and these strategies are used by some of the most successful investors on Wall Street. Follow along till the end of the video to find out how you can consistently gain money while minimizing your risks. So without further ado, let's jump right into it. Tip number 1 is to not trade with emotions. Do not trade with emotions. And although this may seem as something that's extremely obvious and that everyone knows, it's easy to forget sometimes. And it's just worth reminding you one more time. There are a couple of reasons why trading with emotions is bad, but overall it always leads to harmful outcomes. Because when you allow emotions to interfere with your rational thinking, it leads to bad decision making and through many ways. The first of which is through fear. When you see the price of a share just dip a tiny bit during the day, this can trigger an emotional response that causes you to panic sell it, which could potentially make you miss out on tons of profits in the future because you sell it right away. The second is through overconfidence. Sometimes we become greedy about a stock and think that since it's rising right now, it will continue rising in the future, and this can cause us to ignore targets or other red flags that should be telling us to sell the stock. Potentially a company could be doing very bad, very poorly, but because we're overconfident and we think that the stock will eventually rise in the long term or in the short term, we will try to hold on to it. This can be very harmful. So I'll give you an example here with a hypothetical stock, right? So let's just say it's rising a bit like here, right? So if you're looking at the stock every day, you could become very scared as you see right here that it is dropping, right? Just a small drop. This can cause you to panic and then quickly sell the stock, even though in the long term it's actually going upwards, and you're missing out on all of these gains, right? However, on the other hand, if, for example, you had the stock here and you said, hey, well, the stock's going to continue to rise, right? It's going to continue to rise forever, and I will get so much money from this stock, only to realize that it comes crashing down all the way, and you lose all of the money that you get, all the money that you actually earned, right? So we see that you have to keep control of your emotions and to not let them interfere with your rational thinking. So how can you do this, right? First of all, we can avoid checking the stock price too often. Checking often. Force yourself to put the phone away or just not look at the screen and check stock prices during the day, as these can trigger emotional responses that may cause you to make bad trades, right? Because if you just see that the price shifts or it's really volatile and it drops by a bit, this can cause you to panic sell. So just simply not looking at the screen can stop yourself from doing these actions. Secondly, stick to a plan. Right? Stick to a plan. When you stick to a plan, you're more confident in your actions and your investments, so that you will believe that in the long term it will go up. So you're not going to be so affected by the panic selling or fear or overconfidence that eventually it might like drop, right? So by knowing and researching the company and actually knowing full well how the company might grow in the future, you'll be better able to predict what happens and know when to sell and when to buy. Our second tip for today is to cut losses early. Sometimes when a price starts dropping, it's often necessary to sell the stock immediately to save your money. For instance, if there are signs that a company is not doing so well, if they have low revenue, if they report high debt, or if they have recently hired bad executives, these are all signs that the company might not do well in the future. Right? So it's often a good idea to sell the company immediately so you don't lose the money as the stock price drops. For instance, let's just say we hypothetically have the stock that is trending downwards, as you can see, and you have the stock at currently right here. So when you think that, for example, the company just reported low revenues, then this could be a sign for you that the stock might drop, and you can see that it started dropping just a bit. So this signal should tell you that you should probably sell it right here, so that it prevents you from losing all of this money and losing all the gains that you might have got in the past. Now, a good way to do this is to set a stop price for the stock. So as soon as the stock dips below the certain level, you sell it immediately. We'll go into this into more detail in another video in the future, but this is just a good idea to keep in mind. It's also good to have a plan, so that so you have a predetermined price that you think that if it goes below this price, you'll immediately sell it, which prevents you from hanging on to it and not letting go. You can also just buy the shares back at a lower level, like after it has dipped, which basically means that you can keep the shares but opt out of the losses in the future, right? And one more important thing to keep in mind here is to not feel emotionally connected to a stock, which I touched on earlier, right? Oftentimes we think that, oh, the stock will go up in the future. Eventually it might go up as it continues to go down because you feel connected to the stock, and you just keep telling yourself it will go up eventually. Try not to let this happen to you, and try to be as rational as possible when you invest. Our third tip for today is to secure profits. Secure your profits. It's important to not be greedy and think that a stock will go up forever, because this is simply not the case at all. So once you see signs that a stock might begin to fall, sell it immediately. So sell as soon as signs appear. Stocks don't go up forever, and they'll eventually fall, always. So don't be greedy and think that they will rise infinitely. And oftentimes, stocks are overpriced, and they will be corrected by the stock market, and you can easily lose a lot of money instantly. So it's important to keep in mind that it's important to be satisfied and have realistic expectations of how much money you can gain from a stock, and not expect to always get 10%, 20%, or like 100% returns on every single stock. Be realistic with your expectations, so that will prevent you from becoming greedy. Our fourth tip for today is perhaps one of the most important, and that is to diversify. Right? Now, what does this mean, right? It means to not invest all of your stocks into one specific company or one specific industry. In other words, don't put all of your eggs in one basket. Don't put all eggs in one basket. This might seem really intuitive, right? Because as soon as one company fails, you will instantly lose all of your money, right? So you will want to invest in multiple companies, so in case one of them fails, you still have all the other companies that are still rising and still giving you money that can offset the losses from that one company that fails. And also, try to diversify your stocks into different sectors, right? Because market trends often apply to multiple companies within a single sector. Diversify across sectors. So what do I mean by this? For example, if you invest tons of money into natural gas and oil stocks, and all of a sudden gas prices and oil prices suddenly fall, then you'll lose all of your money that you've invested into this sector. So it's important to diversify across multiple sectors in order to save your money. So for example, you can buy like biotech, AI, electric vehicle, and renewable energy stocks. So in case one sector goes bad, you still have all the other ones still generating income. Tip number 5. Pick companies that will grow. Companies that will grow. When you're picking stocks, the number one question that you should be asking yourself is, will the demand increase in the future? Will the demand for the services or the goods that this company provides increase in the future? Because if the demand does increase, that means that more people will be interested in this company or in this industry or what the company does, so more people will be willing to invest in it in the future. this will cause the stock price to go up. And if the company, for example, does something that is becoming outdated and less people need this industry's services, then you should consider not investing in this company. Also, another thing to keep in mind is the brand image of the company, right? So you should think whether or not the company has a positive reputation in the community and in the globally, right? Brand image. You want to invest in companies that are trustworthy and have a reputation of being able to grow and to be able to be trustworthy in their services. Tip number 6. Pay attention to the media. Right? Now more than ever, events in the news and in social media where everyone can access has a major impact on the price of certain companies and stocks. Thus, it is imperative for you to keep track of a company's brand image and public opinions on this company. So, look out for important announcements. Look out for important announcements. So what do I mean by this? There are different kinds of announcements that you should keep in mind, right? You can look at reports of revenue, right? So look at revenue and financial statements, finances. If a company is faring well, then they will have good finances and they'll be able to have higher revenues and lower debts. However, if they're doing very poorly, then they would probably have lower revenues and thus less people would be willing to invest in it, and its stock price will probably go down. Also, look at news for breakthroughs, such as like a new technology or a cure for cancer or other things that will push up the price by a significant amount. Breakthroughs, because they're such huge events, it pushes so many people to suddenly buy the stock and will inflate the price by a large amount, basically instantly. And finally, look out for new executives. Look out for people who have good reputations, and when very famous people or people that are very renowned become executives of a company, this usually signifies good performance of the company, and it will mean that it will make more people have optimistic long-term prospects of the company. Tip number 7 is to dollar cost average. Dollar cost averaging. So if you don't know what it is, dollar cost averaging is investing a set amount of money over repeated intervals. So investing a set amount over regular intervals. So for example, you may put $500 into a stock once every week or once every month. Maybe you put like $2,000 into this fund every 3 months, for example. And usually this is applied to mutual funds, index funds, or ETFs and other pooled funds. Now this is an incredibly useful strategy for a number of reasons. First of all, just because you can't predict the market, right? So by implementing this strategy, it prevents you from being subject to temptations to buy high and sell low, which is often counterproductive as the market is often very volatile and you can't actually end up predicting at the correct times. So by forcing yourself to only invest at specific times, you average out the cost, the price that you pay, right? So you average, which is why it gets its name, right? Average out the price you pay. Now, instead of like risking, for example, buying less shares, because you bought the stock at the wrong time when the share price is high, the overall price that you pay is evened out over multiple periods of time. And finally, it helps mitigate the effects of emotions. This is one of the best ways to mitigate effects of emotions, because you're sticking to a plan and you're following the plan regardless of the price of the stock and regardless of how you feel that day, because no matter what, during this time, because you've set at the specific interval, you're going to buy shares at the specific time instead of, for example, buying more when prices are rising or panic selling when prices decline. Tip number 8 is to average up. This might be another unfamiliar term, but I'll just talk about it right now. So many investors, they try to make up for a bad investment by pouring in even more money into the stock, thinking that eventually it will rise, right? This is called averaging down. But this tactic has very major flaws, because perhaps the investor was wrong about the shares in the first place, that it wasn't actually a good investment. So if it wasn't a good investment, it doesn't make sense to be pouring more money into a stock that stock that isn't actually going to perform well in the future. But also, they're probably falling for a reason, right? So in most cases, the stock will continue to go down for some more time. So if you're going to average down, it is crucial to justify and understand whether or not the stock will actually rise again. The only way to do this is to have an actually solid understanding of the stock market and the stock that you're investing in. So because downward trends are very common, and can last a long time. So you can end up losing a lot of money if you just pour more money into a losing stock. So instead, what you should do is you should average up. This means buying more of a stock as it is rising, right? Because when it is rising, it's probably going to be rising for a good reason. Buy more. It means that your original investment has paid off. So if a stock is doing well, usually uptrends can last a long time if the underlying conditions and causes for the uptrend are sustained. So buy more when rising. This is extremely good because if you average up, the chances is that this is a good stock, and long term it can be performing very well. So you could be potentially gaining a lot more money if you put more, if you invest more into a stock that is trending upwards and is likely to be sustained. Finally, we're on to our last tip. So tip number 9, keep a long-term perspective. And I would say that this is the most important tip in this entire video. Keep a long-term perspective. When you invest, try to look for long-term gains, where your investments will gain value over time, over a long period of time, across years, across decades, rather than trying to get gains every single day through day trading. There are a couple of reasons for this. Firstly, on how you can't beat the market. Can't beat the market. Because there's so much volatility, it's impossible to always know whether the stock will go up or go down when it's at a specific time. It's called speculation, right? You can only look at the price in the past, but you'll never know for sure what it will be in the future. So by betting it daily, you have a very high chance to lose a lot of money, and perhaps an equal or even higher chance that you have of gaining money. So it's very quick and easy to lose tons of money through day trading. But also, because the people who you're betting against are going to be the most successful people on Wall Street and the best corporations, and they use softwares and algorithms to trade, right? They can detect the price changes in milliseconds. Like as soon as the price shifts are submitted, they can quickly and immediately buy or sell. So if these are the people who have like the highest level algorithms, these are the corporations that are doing the investing and day trading, it's impossible for you to bet against them and to be more successful in your betting than them, because every investment that you make, a buy or a sell, is ultimately they're the people who are going to be like the opposite of your order. So they're going to be the ones who benefit from every opposite action that you take. So instead, what should you do, right? You should buy and hold to your stocks. Hold on to your investment. Markets always go up in the long term, right? Because of inflation. So in the long term, any stock that you have, in general, if it is a good industry and you have followed all my other tips, usually in the long term, it will go up eventually. And especially pooled funds such as index funds and ETFs, they're especially good because they have a numerous different stocks that always follow the general trend of going up, regardless of the market of a specific industry or a company's performance. So in general, I'd say it's better to have a low risk of losses because if you have a long-term perspective, because eventually everything in general will have long-term gains, rather than seeking risks for high losses, but also have frequent short-term gains, which is what you get from day trading. So keep in mind, try to always have a long-term perspective for every investment that you make. Will it make money for you in the long term? Thanks for watching, guys. If you like this video, make sure to like, subscribe, and share it with your friends. It would truly mean a lot to us here at InvesTips. If you learned a thing or two, make sure to check out our other videos. We have lots of excellent content, and you'll continue to learn a lot about the stock market and investing. Finally, make sure you check out Wealthsimple. It's an excellent $0 commission-free trading app for Canadians, and if you sign up using the code here below, EV8VW, you can get a free $10 and a free stock as you start off after you trade and invest $100. So make sure to check it out. It's a great trading app that I use myself for investing, and I highly recommend it for other people too. Once again, thank you so much, fellow investors, and I'll see you next time.